All right, class, welcome. If you own an incorporated business in Canada or plan to one day, you're going to face one of the most critical strategic decisions there is. How do you pay yourself? You have a choice between taking a salary or receiving dividends, and as we're about to see, the best answer, well, it's rarely simple.
My name is Dr. Samir Al-Rashani. In this explainer, we're going to really break down this critical topic. My goal is to give you a clear, comprehensive understanding of the choices you have as a business owner.
So here's our roadmap for today. First, we'll frame the core dilemma. Then, we'll dive into a key tax principle called integration before, and this is the really exciting part, revealing the most powerful wealth-building tool in this whole equation, tax deferral. After that, we'll cover factors beyond the numbers, and finally, pull it all together so you can craft a practical strategy.
Okay, let's start with the dilemma itself. Every single owner, manager of what's called a Canadian-controlled private corporation, or CCPC, has to make this choice. And while it might seem simple on the surface, its impact on your taxes, your retirement savings, and your cash flow is just massive. And listen, this isn't just some abstract theoretical question we talk about in a classroom. As you can see from this Reel post, actual business owners are wrestling with this constantly. It's a very practical problem that really needs a clear answer. So let's just lay out the fundamental differences here. A salary, which you get on a T4 slip, is a business expense. That means it lowers your company's taxable profit. It also means you have to contribute to the Canada Pension Plan, or CPP, and it builds up room for your RRSP. Dividends, on the other hand, are totally different. They're paid from the company's after-tax profits, you don't pay into CPP, and they don't generate any RRSP room, but they offer a ton more flexibility. Let's keep this basic framework in our minds as we go. Okay, this brings us to our next big concept, the principle of integration. Now, this is the core theory behind all of corporate tax in Canada, and you absolutely have to understand it to make the right choice. So in short, integration is all about making the tax system neutral. The big idea is that whether you earn, say, $100,000 personally as a sole proprietor, or your corporation earns it and then pays it all out to you, the total tax you end up paying should be pretty much the same. In a perfect world, the choice between salary and dividends wouldn't really matter from a tax perspective. Now look at this, because here we can see integration in action with a real example. On the right, if you take a salary, the corporation pays zero tax on that money, and you, the owner, pay about $53,000 in personal tax. Now look at the left, the dividend route. The corporation first pays about $12,000 in tax. Then you, the owner, pay personal tax on what's left. But look at the bottom line. The total tax paid is remarkably close. There's only about a $586 difference. That's integration at work. But, and this is a big but, as that example showed, it's not exactly the same, is it? The reality is, integration is rarely perfect because of all the different federal and provincial tax rates. And it's these little imperfections, this under or over integration, that create the first layer of strategic decision-making. And this brings us to what I believe is the most important concept in this entire discussion, the power of deferral. This is where we stop looking at a single year and we start thinking about long-term wealth creation. This is the real game changer. Here's the key idea, everyone. If you don't need all the cash for your personal life right away, you can leave it inside the corporation. And since corporate tax rates are so much lower than top personal tax rates, you're left with a much larger pool of capital inside the company to invest. That is the magic of tax deferral.
Let's go back to our Ontario example. Remember that tiny $586 tax cost of choosing dividends? We'll look at the trade-off. By paying that small corporate tax instead of the massive personal tax, the business owner creates a tax deferral of over $41,000. That is $41,000 more that stays inside the company working for you, ready to be invested.
This chart just perfectly illustrates the long-term impact. The black line, that's your investment growth if you took a salary and invested the smaller after-tax amount on your own. Now, the red line shows what happens when you invest the much larger tax-deferred amount inside the corporation first. It starts a little lower, but just watch what happens over time.
So right at the beginning, the salary strategy leaves you with a little more cash. But because the dividend strategy gives your company a much bigger pile of money to invest, it catches up incredibly fast. In this example, the break-even point is just 1 year. After that single year, the corporate investment strategy starts to pull away, and it never looks back. Now let's fast forward 30 years. The power of compounding on that larger initial amount is, well, it's undeniable. The strategy of using dividends and investing corporately results in over $34,000 more in your pocket, and that's after all the taxes are finally paid. That right there is the incredible power of deferral. But, of course, as we know, the decision isn't based on pure tax mathematics alone. Real life always gets in the way, and there are several critical non-tax factors we absolutely have to consider to get the full picture.
So, a salary is crucial for building RRSP room and for getting CPP benefits. Those are key pillars of retirement planning for most people. And very importantly, it gives you that steady T4 income that banks and lenders just love to see when you're applying for a mortgage. Dividends give you none of that, but what they do give you is huge flexibility and way less paperwork, since you don't have to deal with payroll.
And this anecdote here from a real business owner perfectly illustrates that mortgage issue. Think about this. Even though their partner had years of solid income from his corporation, the lender found it easier to just ignore it and qualify them based only on the spouse's traditional T4 salary. This is a real-world friction point you have to be aware of if you're thinking about a dividend-only strategy. So, we've examined the theory, we've crunched the numbers, and we've talked about the practical considerations. Now, let's pull all this together into a cohesive strategy. Ultimately, for most people, this isn't an either-or choice. For almost every business owner, the best strategy is a hybrid, a mix of both. It's all about taking just enough salary to hit your RSSP and CPP goals and to keep the bank happy, while using dividends to unleash the incredible power of tax deferral for long-term growth inside your company. And that brings us to the final critical question that you have to ask yourself. What's more valuable for your future? Is it the mathematically superior long-term growth you get from tax deferral, or is it the stable traditional foundation of CPP and RRSPs? The right answer, class, depends entirely on your personal goals, your tolerance for risk, and your own financial discipline. It is the most important strategic conversation you can have about your business.